Stocks versus real estate. What is the better investment? Investing is a cornerstone of wealth building, and among the most debated investment vehicles are stocks and real estate. Both have proven to create significant wealth for investors, but each carries its own advantages, risks, and requirements. This analysis dives deep into the nuances of both, helping you make a more informed decision based on your financial goals, risk tolerance, and investment strategy. 1. Basic definitions and mechanisms. Stocks. Stocks represent partial ownership in a company. When you purchase a share, you essentially own a small fraction of that business. Returns are generated through capital appreciation, when the stock price increases. Dividends. Periodic payments from a company's profits. Stock investments can be made through direct stock purchases, mutual funds, or ETFs, exchange-traded funds. Real estate. Real estate investing involves purchasing physical properties, residential, commercial, or industrial, with the intent to earn returns via rental income. Monthly payments from tenants. Appreciation, increase in property value over time. Tax advantages. Depreciation, mortgage interest deductions. Real estate can be held directly or through REITs, real estate investment trusts, which resemble stocks but are backed by real property. And 2. Historical returns. Stocks over the past 100 years, the S&P 500 has returned an average of 7 to 10% annually after inflation. These returns include dividends and capital gains. However, returns fluctuate based on market cycles, economic conditions, and investor sentiment. Real estate. Real estate has historically offered 3 to 5% annual appreciation in value, with total returns, including rental income, averaging 8 to 12%, depending on location and leverage. However, returns vary widely based on property type, market trends, and management quality. Comparison. Stocks offer higher long-term average returns but are more volatile. Real estate can match or exceed stock returns in hot markets or with effective leverage, but it requires more hands-on management liquidity. Stocks. Stocks are highly liquid. You can buy or sell shares almost instantly during trading hours on an exchange. This allows for quick access to cash and easy rebalancing of a portfolio. Real estate. Real estate is illiquid. Selling a property can take weeks or months and incurs significant transaction costs, agent fees, taxes, legal costs. In down markets, liquidity drops even further. Winner. Stocks, by a wide margin for liquidity. 4. Risk and volatility. Stocks. Stock markets can experience significant short-term swings due to economic reports, interest rate changes, geopolitical events, and company-specific news. The volatility is visible and immediate, which can be psychologically taxing. Real estate. Real estate tends to be less volatile in the short term. Prices don't change daily, and downturns often play out over months or years. However, risk still exists. Tenants can default, natural disasters can damage property, and local markets can decline. Comparison. Stocks have more visible, frequent volatility. Real estate has hidden risks, but generally appears more stable. Number 5. Leverage. Stocks. You can buy stocks on margin, but this is risky and heavily regulated. Losses can exceed initial investments if markets turn against you. Real estate. Real estate is ideally suited to leverage. Most properties are purchased with mortgages, allowing you to control large assets with limited capital. If property values increase, leveraged returns can be significantly higher than stocks. Example, $100,000 property with 20% down, $20,000. If property value rises 10%, that's a $10,000 gain, 50% return on your investment. Advantage, real estate, thanks to favorable leverage structures. 6. Taxes and deductions. Stocks. Capital gains taxes on profits, 0 to 15% or 20% depending on income and how long you held the investment. Dividend taxes, depending on type, qualified versus ordinary. No tax shelters for losses unless you sell. Real estate. Depreciation deduction reduces taxable rental income. Mortgage interest is deductible. 1031 exchanges allow deferring capital gains taxes by reinvesting in another property. Often more tax efficient for long-term investors. Advantage real estate, particularly for high earners seeking tax shelters. Management and time commitment. Stocks. Passive investing is easy with index funds or ETFs. Minimal effort beyond portfolio rebalancing. Real estate requires active management, dealing with tenants, maintenance, legal issues, and local regulations. Alternatively, you can hire a property manager, costs 8 to 12% of rental income. REITs offer a more passive real estate option. Winner, stocks, for ease of management and time efficiency. 8. Barriers to entry. Stocks, low entry point. You can start investing with as little as $5 to $100. Fractional shares and zero commission trading have democratized stock investing. Real estate, high upfront costs, down payments, closing costs, inspections, and repairs. Limited access for those without good credit or substantial capital. Advantage, stocks, especially for beginner or small budget investors. 9. Stocks, easily diversified across sectors, geographies, and companies. ETFs allow access to thousands of companies globally. Real estate, harder to diversify unless you have millions to invest. Market specific, buying in one city ties you to that region's economic health. Winner, stocks due to low-cost, high-impact diversification. HARP 10, inflation hedge. Stocks historically beat inflation, especially when companies can pass on higher costs to consumers. Certain sectors, like energy or commodities, perform better during inflationary periods. Real estate, excellent inflation hedge. Rents and property values often rise with inflation. Fixed-rate mortgages become cheaper in real terms. Advantage, real estate, especially for income investors. Nushkar 11, emotional factors. Stocks, easy to panic during crashes, e.g. 2008-2020. Requires emotional discipline and long-term thinking. Real estate, tangible asset that feels more secure to many, but also emotionally draining due to tenant issues and property responsibilities. Depends on the investor. Some feel safer with tangible assets, others prefer the detachment of stocks. 12. Passive income potential. Stocks, dividend stocks or high-yield ETFs can generate steady passive income. Requires large capital base for meaningful returns. Real estate, rental income provides reliable monthly cash flow, more favorable cash-on-cash returns with smart buying and leverage. Real estate wins for predictable monthly income, especially if you want to live off cash flow. 13. Exit strategy and estate planning. Stocks, easy to sell, liquidate, or pass to heirs. Step up in basis may reduce capital gains for heirs. Real estate, more complex estate planning. Properties can be passed on with step up in basis too. Selling may take time, but properties can be valuable long-term inheritance assets. Equal, depending on goals and planning. Final verdict, which is best? Criteria, winner, historical returns, stocks, liquidity, stocks, risk management, real estate, leverage, real estate, taxes, real estate, time management, stocks, accessibility, stocks, diversification, stocks, inflation protection, real estate, passive income real estate. Summary. Choose stocks if you prefer passive investing, low entry costs, high liquidity, and diversification. Choose real estate if you want tangible assets, strong cash flow, tax advantages, and are comfortable with property management or leverage. Hybrid strategy, best of both worlds. Many seasoned investors recommend a balanced approach. Stocks provide liquidity, growth, and diversification. Real estate offers stable cash flow and inflation protection. A portfolio with 70% stocks and 30% real estate, or via REITs, can create robust, balanced returns. Conclusion. There's no one-size-fits-all answer. The best investment depends on your goals, timeline, capital, and risk tolerance. By understanding the deep advantages and trade-offs between stocks and real estate, you can craft a strategy that suits your financial journey.